In business, revolving basically means the credit is reusable. It works exactly like a credit card,
revolving
but on a much
basically
larger
means
scale.
the credit is reusable.
When a credit facility is
exactly
revolving,
like
the
a
company can
revolving
borrow on a much
basically
larger
means
scale.
the credit is reusable.
When a credit facility is
exactly
revolving,
like a
the company can
revolving
borrow on a much
basically
larger
means
scale.
the credit is reusable.
When a credit facility is
exactly like
revolving,
a
the company can borrow on a
facility,
revolving credit facility, revolving credit facility, revolving credit facility,
大家好，看，这是我的晚
lines of credit, undrawn,
For an investor, this table reveals how management is balancing growth with financial risk. While the company is profitable enough to make repayments, it is choosing to expand its leverage. Here are the key takeaways. 1. Significant increase in total leverage. The most immediate takeaway is that the company's total debt load is growing. They are borrowing more than they are paying off. Total debt increase, $1,969 million asterisk calculation. 37,968, text, ending total. 35,999, text, beginning total, equals 1,969. Percentage growth, 5.47% increase in total debt in just 9 months. Calculation, 1,969, div 35,999, times 100 equals 5.469%. 2. High burn rate of long-term debt. Investors should notice the reclassifications line, $3,551 million. This represents the conveyor belt of debt. Over the next 12 months, a large portion of their long-term debt will become due. Takeaway: the company reclassified $3,551 million into the due within 1 year bucket, but only repaid $2,625 million during this period. This suggests the company may need to roll over, refinance, its debt soon rather than paying it off with cash from operations. 3. Shift toward short-term liquidity pressure. The company's immediate obligations, debt due within a year, have increased significantly. Increase in short-term burden, 35.6%. Calculation, 3,523, text, ending. 2,598, text, beginning, equals 925. Percentage, 925, div 2,598, times 100 equals 35.6%. Investor concern. Management must ensure they have enough cash flow or credit lines to handle $3.5 billion in payments over the coming year, compared to the $2.6 billion they handled previously. 4. Currency sensitivity. The $611 million increase from currency and other adjustments tells investors that this company has significant international exposure. Takeaway: roughly 31% of the total debt increase this year was not from borrowing more money, but simply from unfavorable exchange rate movements. Calculation: 611, text, currency adjustment, div 1969, text, total debt increase, equals 0.3103, text, or 31%. Investor concern: if the US dollar continues to fluctuate, the company's debt costs could rise even if they don't take out any new loans. Summary for an investor: the company is in an expansionary phase, issuing nearly $4 billion in new debt, but its short-term repayment obligations are rising rapidly, up 35%. An investor should check the company's cash and cash equivalents on the balance sheet to ensure they have the liquidity to cover the $3.5 billion due this coming year. Would you like me to explain how to find the debt-to-equity ratio if you have the rest of the financial statement?
Covenants.
Covenant.
Covenant. Fine print. Maturity date. Maturity date. Peer reviewed. Peer reviewed.
Dogecoin, Doge, is a peer-to-peer cryptocurrency similar to Bitcoin. Dogecoin can be used as a medium of exchange and as a way to transfer money between people, either as a payment for goods or services, or simply to send cash. But it is primarily used for tipping content creators on various social media platforms. Bitcoin, BTC, is a decentralized currency that eliminates the need for central authorities such as banks or governments by using a peer-to-peer internet network to confirm transactions directly between users.
At the NASDAQ as the company transitions its shares to this exchange from the NYSE. Joining us right now ahead of his departure from his role heading the company in January is Doug McMillon. He is Walmart's CEO. And Doug, thank you for joining us this morning.
Good morning.
We got so much to talk about, not a lot of time. So let's jump in right away with why you're making this move to the NASDAQ. That's a really big deal. It's the biggest company that's ever moved to the NASDAQ from the NYSE. What happened?
Yeah, there are a lot of factors. The team went through a rigorous process to sort that out. I think things like the cost to list and trading execution, things like that matter. But in this particular instance, the ability to participate in the NASDAQ 100 and to be associated with the brand of NASDAQ, given the progress the company's made as it relates to technology, is kind of what rose to the top.
Yeah,
Walmart's changed a lot, and we're trying to make sure everybody knows it.
Walmart's changed a lot under your leadership over the last 11 years. It has been a really huge transformation, I'd say, in the company. The shares up 350+%, I think 355% since you took over there. Why are you stepping down now? Why are you leaving? You're not even 60 years old yet.
I don't know if I'm young or I'm old. I get a little confused about that from day to day. But I think when you see somebody, thank you, when you see somebody who's ready to run the next lap better and faster than you are, it's time to hand the baton and get out of the way and just cheerlead. And that's what's happening. I had a great opportunity to do this job for a long time, and I'd like to see that happen for the next person. And John's ready to do it.
Wisdom and experience, though. Right? I know he might run faster, but
John's been with the company for more than 30 years. He's 8 years younger than I am, but he's done everything. Yeah, that's
you want to live, I guess, probably. That might happen.
Living sounds like a good idea, but I was loving what I was doing.
Right.
I mean, this is a great situation. It's really ideal. John's done all the jobs in the company: merchant, operator, sourcing, worked in all three segments. His dad worked at the company. He met Sam Walton when he was a kid. He met his wife at Walmart, loves the company, loves our associates, and has a vision for the future. And with what's happening with AI, I could start this next big set of transformations with AI, but I couldn't finish it.
Well, that's really interesting. I mean, this is the only job. He sounds very much like he's got the same CV as you. You started out, I think 1984 was your first job with the company, and that was a summer job where you were unloading trucks at the warehouse, but you've been there your entire career too.
Yeah. There's a bunch of us. Like if you walk the hallways and you met the people in our stores, you'd find a bunch of associates that have been there for a long time that really care about the business. And also willing to change. When I look back on what's happened on this decade plus, One of the things I'm really proud of is that our associates at store level, Sam's Club, distribution centers, home office, leadership, they've all stayed true to the purpose, values, and culture of the company, but they've been willing to change in a lot of different ways, and it's worked. You can't get growth without change.
When did you start thinking about this? And it's so interesting because there are a bunch of CEOs, we don't need to say their names, who like to stay at the party. And even when they leave, they like to come back to the party. But for some reason, we've known each other a while. I don't think that's in your DNA. What do you think that's about? So I'm trying to just understand, sort of, as you were thinking, as you said, 59, was it the last couple of years where you were thinking, okay, maybe
Last year or so in particular, but we've got a great board, and Greg Penner's our chairman. He does a fantastic job. It's an advantage to have the Walton family involved in our business. And we talk about succession planning at every board meeting. And about a year ago, I really started feeling like this next run, you could see what agentic commerce was going to look like, the vision for AI shopping. And I started thinking about everything that needs to happen over the next few years. And it really caused me to think that now was the right time.
CEOs make how many decisions a day would you say? Small, large, thousands in a week.
A lot.
How many employees? 1 million?
2.1 million.
2.1 million. So one guy, and we hear all the time, oh, a CEO, what difference can he really make? I mean, I go back in time, I remember GE and Westinghouse were the same company at one point. One got Welch, one got some other guy. And there's a Target Walmart chart, and I don't want to pick on Target, but you weren't obviously the same company, but you had some of the same decisions that you had to make. Look at the difference that a CEO can make at a company. Are you going to write a book or something? What was
I don't
the
know
difference?
about that. I drew an ace off the deck. I came to see you guys early after taking this role, and we made a big wage increase. We invested in price. We started getting after e-commerce. We invested in technology. And we had the board supporting us in doing all that. Not everybody has that opportunity. It took the operating income percentage of the company down for a sustained period of time.
And Walmart,
and it's taken us a while to come back.
Down, right? And you had the support not just of the board, but also the Walmart.
Not everybody has that.
But that conviction and that ability to see through it, everybody's copied your playbook since then. You were the first to do it, but everybody got around to kind of following that and saying that's the right way to do it.
It's been a lot of fun to do it with all these people. At this moment in time, as I look back on it, all the memories of all the hard stuff that we did together and the moments when we were really doubted, that's what makes it so sweet right now.
You've mentioned twice already the AI change that's coming to retail and how that there are huge things that have to happen over the next couple of years. What are those things? What are you seeing?
It's really exciting to think about what can happen. If you think about all the things that people love about shopping, we have the opportunity to increase those and invent new ways to shop. And we have the opportunity to reduce some of the friction like we've never done before to take out the things that people don't enjoy doing. We're building an experience that replaces the old app and website that's AI native, that's more personalized, understands shopping context, presents itself in a multimedia way. If you're browsing for fun, it may look more like TikTok. If you're replenishing, it looks more efficient. If you're searching for one item, it's helpful and precision. If you're planning an event, like a birthday party or something, it's better at that. It'll use video. There'll be creators involved. And we've started building that product today. We call it Sparky, and it will grow as we go into the next year. That's going to be a different front end for customers. Then think about all the stuff that's going to happen with better inventory management, all these investments we've been making in physical automation paired with data and increasingly intelligent software powered by AI.
But it's not getting harder.
Change the whole system.
That's not what it is. There's not clouds on the horizon. And I love John Mueller, and he did an exit interview here on P&G. But P&G, since he announced that he's leaving, we didn't understand it. He's a young guy too. P&G has, I wonder if there was something to the decision that I don't need this anymore or something. There's no storm clouds, nothing in the future of.
No, not in my case. And I think what you're going to see from the Walmart team is they're just going to keep scaling what we've already started, build some new stuff on top, and then use AI to transform it all. It's better.
In
at
this
that.
interview, outgoing Walmart CEO Doug McMillon discusses his tenure, the company's transition to the NASDAQ, and the future of retail. Here are the key ideas.
Tenure. Tenure.
Strategic transitions. Move to NASDAQ. Walmart transitioned from the NYSE to the NASDAQ to align with its identity as a technology-driven brand and to participate in the NASDAQ 100. Leadership succession. McMillon is stepping down in January, passing the baton to John Furner. He believes it's the right time because the next phase of growth, centered on AI, requires a leader who can see the entire multi-year transformation through to the end. Philosophy on growth and change. Growth requires change. McMillon emphasizes that sustained growth is impossible without a willingness to evolve. He is proud that Walmart associates have remained true to the company's core values while embracing massive changes in operations. Long-term conviction. Early in his tenure, McMillon made heavy investments in wages, price, and e-commerce. Despite these moves temporarily lowering operating income, the support of the board and the Walton family allowed the company to stay the course, leading to a 350% plus increase in share price over 11 years. The future of retail, AI, and automation. Agentic commerce. Walmart is developing an AI native shopping experience, currently called Sparky, that replaces traditional apps and websites. It aims to be multimedia-driven, personalized, and context-aware, looking like TikTok for browsing or a high-efficiency tool for replenishment. Operational efficiency. Beyond the customer interface, AI will be used to revolutionize inventory management and physical automation, removing friction from the shopping process. Culture and legacy. Promoting from within. Both McMillon and his successor, John Furner, started as hourly associates. This highlights Walmart's culture of longevity and promoting leaders who understand every level of the business. Leaving at the right time. McMillon refutes the idea of storm clouds on the horizon, stating he is leaving simply because the company is in an ideal position and the next leader is ready to run the next lap faster.
Refute.
Apple could see a significant stock rally in 2026 driven by three key factors: AI, success, improving Apple Intelligence to create a reliable, paid subscription model. Vision Pro growth, shifting the headset from a luxury item to a vital tool for major corporations. Stock buybacks, continuing to spend billions to buy back shares, which boosts investor value. However, risks remain. Regulatory crackdowns on the App Store, falling sales in China, and historical tendencies for the stock to drop sharply during market crashes could offset these gains. Would you like me to break down the specific financial risks mentioned in the text?
Tell One of the most powerful names in global tech has just placed a quiet but telling bet on Nike. Apple CEO Tim Cook has bought nearly $3 million worth of Nike stock, a move that has instantly put the spotlight back on the struggling sportswear giant. According to an SEC Form 4 filing, Tim Cook, who is Nike's lead independent director, purchased 50,000 shares of Class B stock on December 22nd, paying a weighted average price of $58.97 per share. That purchase alone is worth just under $3 million. After the transaction, Cook now directly owns 105,480 shares of Nike. And that is not just any insider buying. Cook has been on Nike's board since 2005. He is the company's longest tenured director and also chairs Nike's compensation committee, making him one of the most influential figures inside the company. The timing matters. Nike is currently in the middle of one of the biggest strategic turnarounds in its history. The company recently beat earnings expectations, but at the same time warned investors to expect low single-digit revenue declines during the holiday quarter. Nike also flagged continued pressure from higher tariffs and weak consumer demand in China. Cook was not the only board member buying. Another Nike director, former Intel executive Robert Swan, purchased 8,691 shares on the same day at an average price of $57.54 per share. That back-to-back insider buying has revived investor chatter around whether the stock is finally close to a bottom. For markets, purchases like these are often read as a signal of confidence, especially when senior board members step in during periods of weak performance. In simple terms, when insiders buy their own company's stock with personal money, they are saying they believe in what is coming next. Still, analysts say investors will remain cautious. Whether Tim Cook's bet marks the start of a true rebound or turns out to be a long-term waiting game is something the market will now watch very closely. Tell us in the comments, do you see Nike as a comeback story or a value trap? And for more market updates, keep watching Mint News.
Bergerak bring you the insights that
only board member.
The video discusses Apple CEO Tim Cook's recent significant investment in Nike and what it means for the company's future. Here are the key ideas. Tim Cook's significant purchase. Apple CEO Tim Cook, who serves as Nike's lead independent director, purchased 50,000 shares of Nike Class B stock. The transaction was valued at nearly $3 million, with a weighted average price of $58.97 per share. Deep ties to Nike. Cook is Nike's longest tenured director, having been on the board since 2005. He also chairs the compensation committee, making him a highly influential figure within the company. Strategic timing. The purchase comes as Nike undergoes a major strategic turnaround. While the company recently exceeded earnings expectations, it also warned of potential revenue declines during the holiday quarter and faced challenges like higher tariffs and weak consumer demand in China. Broader insider buying. Cook wasn't the only board member investing. Former Intel executive Robert Swan also purchased over 8,000 shares on the same day. Market signal. Insider buying with personal money is often viewed by investors as a strong signal of confidence in the company's future, especially during periods of weak performance. This has sparked debate over whether Nike's stock has finally hit its bottom or if it remains a value trap. Video URL. Link to YouTube.
Jamie, we're talking about the fact that you have lent into technology over the last decade, billions of dollars invested across the business. When it comes to AI, which parts of the JP Morgan business are going to be most transformed by AI?
Yeah, so we've been doing AI since 2012. So people think it's a new thing. Gen AI is kind of new, but not all of AI. We have 2,000 people doing it. Spend $2 billion a year on it. It affects everything: risk, fraud, marketing, idea generation, customer service, and it's kind of the tip of the iceberg. And so, we're deploying it. Every time we meet as a business, we ask, what are you doing in AI? What are you doing to serve your people? Why can you do better? What is somebody else doing? So we're freely deploying it and safely. We have a lot of rules and regulations in place for our own data and how we use it, et cetera.
Is it having a material impact on revenues for JP Morgan? If not now, then when?
So we have shown that for $2 billion of expense, we have about $2 billion of benefit. Some we actually can do real detail. We did this, we reduced headcount, we saved this time and money, we reduced errors. Some you can't. It's just improved service, something like that. It's like almost worthless to say what's the NPV, but we know about $2 billion of actual cost saves. And like I said, I think it's the tip of the iceberg. We're getting better and better at it. We know how to do it. As the managers learn how to do it, they're asking more questions. Why can't it do X and why can't it do Y? And then I don't have my phone here. We have a suite, an LLM suite on internal data to do research and summarize reports and scan contracts and do things like that. 150,000 people a week use it. So it's quite productive.
More and more of your employees are using the agentic AI.
Our own LLM, and agentic is just starting. But that will be deployed over time too. But it's also being used for coding. I mean, it's being used quite broadly now. And like I said, part of it is getting your mind working around how you're going to use this thing. And so our managers and leaders have to do it.
If you look out 5 years, are there more jobs in banking as a result of AI or fewer?
I think people shouldn't put their head in the sand. It is going to affect jobs. So think of every application, every service you do, you'll be using AI. Some to enhance it. Some of it'll be you doing the same job. You're doing a better job at it. There will be jobs that it eliminates. But you're better off being way ahead of the curve and retraining people. So we retrain and redeploy a lot of people. So for JP Morgan, if we're successful, we'll have more jobs. But there'll probably be less jobs in certain functions.
When you look at the spend on AI, infrastructure, chips, OpenAI, it's not making a profit. Loss making, deals of about $1 trillion this year. The hyperscalers, the spend there. What is your reaction when you see those numbers crossing? Are you comfortable with that kind of spend on the infrastructure around AI?
It's a lot. I'm not sure it's all ever going to be totally spent. I think when you look at big tech, like tech that happens like this, and you go look at cars, you go look at television, you go look at internet, big money's got spent. There were a lot of losers, a lot of winners. In total, it was productive. So take the internet bubble. Remember that blew up, and the amount of people. You and I can probably name 100 companies that were worth $50 billion and disappeared, but out of it came Facebook, YouTube, Google. So there will be real big companies, real big success. It will work, in spite of the fact that not everyone who invests in it is going to have a great investment return.
And of course, those investments are part of what has powered this bull market in stocks. And on Sunday, it'll be 3 years of that bull market. Where do you think we are in that bull market? Is there any complacency there? Is it underpinned by rational factors? Is there more momentum?
Yeah, look, we're in a bull market. It's been clear. Asset prices are high. Credit spreads are low. Consumer's still okay. The consumer has jobs. Remember, jobs is what usually starts to force people to cut back and change things, and consumers spend less and companies cut back. So far, so good. There are a lot of issues out there that the economy's got to deal with, from all the geopolitical stuff. Maybe that'll sort out well. What's going to happen to inflation? I'm a little more nervous about inflation not coming down like people expect. That might be a surprise. On the other hand, there's a lot of spending. There's a lot of government spending, which is inflationary too, by the way. And so I don't know. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the US. You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement. We'll deal with it. We'll serve our clients. We'll navigate through it. A lot of us have been through them before. You don't wish it because certain people get hurt, but it could happen in 2026.
We're still, of course, in the US government shutdown.
But I do think there are positives, like deregulation is a real positive, which also helps animal spirits as a positive. And in the one big beautiful bill, there's also more stimulus that has positives for the economy, but maybe negatives for inflation. So how it all sorts out, we'll see.
Markets are looking through the US government shutdown. Is there a period of time, if this shutdown continues, where markets start to wake up and become concerned?
I don't think so. I don't like shutdowns. I think it's just a bad idea. And I don't care what the Democrats, Republicans say. It's a bad idea. It's not a way to run a railroad. I don't think it's critical. I forgot the number, 4 or 5 or 6. One of them went for 35 days. I'm not sure anyone really affected the economy and the market in a real way.
You mentioned inflation. You said you're a little bit more concerned about inflation than maybe some others. Markets pricing in about 100 basis points of cuts between now and this time next year from the Fed. Does that therefore seem reasonable to you, or markets are over their skis in pricing?
I think markets have to make a forecast. I want to point out that forecasts have almost always been wrong, and the Fed's been wrong too. So it isn't like their forecast is going to be accurate. If inflation goes up, starts ticking up for whatever reason, and it might, it's going to be hard to do 100 points. They might do some, and then they have the battle, the give and take of if unemployment starts going up, well, obviously they're going to do some. So we'll see.
you've long talked about geopolitics as being a risk factor. We're seeing gold at $4,000. We're seeing Bitcoin at record highs. The dollar, though, year to date, down about 8% on the Bloomberg Dollar Index. Are you seeing structural shifts out of the US dollar? And is that a sustained theme?
A little bit, but again, I wouldn't have heartburn over it. The dollar did well for a long time. If you own U.S. stocks, so foreigners own something like $35 trillion of U.S. stocks and bonds, and because the stock market's gone up, your allocation to the U.S. has gone up. I think it's perfectly reasonable for investment committees in Europe and around the world to cut back a little bit of their equity ownership. We've also seen people changing their hedge ratios and stuff like that. So it may just be a rational adjustment to, I don't expect a stronger dollar. The tariffs has this effect. But it's still, if you look at America, it's still the greatest place in the world to invest in the long term.
And deal making seems to be picking up. And of course, JP Morgan played a significant role in the takeover, the take private of EA, $20 billion in financing provided by JP Morgan. Is that a marker in the sand? Is that a one-off as a deal of that type? Or is it a sign of more competition between, frankly, the banks and private credit?
Well, look, we're agnostic about private credit. So there may be competition or not. We want our customers to do what's in their interest. We offer both, and we did that whole deal in 11 days. And we didn't do it that way to make a point to private credit. If they said do it differently, we could have done it differently too. And so, but there.
Private credit. Private credit.
In simple terms, private credit is a loan made to a company by a group of investors or a private firm, rather than by a traditional bank. If a bank is like a big box department store, standardized, regulated, and sometimes slow, private credit is like a high-end tailor, customized, faster, but more expensive. A simple example, the Gourmet Bakery. Imagine you own a successful local bakery chain called Gourmet Crumbs. You want to expand nationwide, which requires $20 million. The bank route. You go to a big bank. They have strict rules. Because your business is growing fast but doesn't have 50 years of history or massive buildings to use as collateral, the bank says no, or offers you only $5 million. The private credit route. You meet with a private credit fund. They spend 2 weeks looking deeply at your actual sales and recipes. They agree to give you the full $20 million. The catch. They charge you a higher interest rate, e.g., 10% instead of the bank's 6%. The benefit. You get the money fast. They don't take any ownership, equity, of your company, and they might give you a flexible repayment holiday while you build your new kitchens. How it works, the ecosystem. Private credit connects 3 main groups through a private deal that doesn't happen on a public stock exchange. The borrowers, usually medium-sized businesses that are too big for a small local bank but too risky or unique for a global bank. The lenders, private firms like Blackstone or Apollo, that raise pools of money from wealthy individuals and pension funds. The agreement, the terms, interest, when to pay back, are negotiated directly between the two parties. This is why it's called direct lending. Why is it so popular right now? Feature: traditional bank loan, private credit loan, speed, slow, months of red tape, fast, weeks to close, flexibility. Rigid, one size fits all, custom, tailored to your business, cost. Lower interest rates, higher interest rates, regulation, highly regulated by the government. Less regulated, more private. Key risks to know. Illiquidity. If you are an investor in a private credit fund, you can't just sell your investment tomorrow like a stock. Your money is often locked up for 5 to 10 years. Higher default risk. Because these lenders take on companies that banks rejected, there is a higher chance the company might struggle to pay the money back. Would you like me to explain the different flavors of private credit, such as mezzanine debt or distressed debt?
There's a lot of merger talk, and we did that whole deal in 11 days, and we didn't do it that way to make a point to private credit. You know, if they had said do it differently, we could have done it differently too. And so, but there's a lot of merger talk. There's a lot of firepower. There's a lot of tech. You know, we had a bunch of IPOs in the U.S. I know there've only been a handful here. The tech world is still doing quite well. You know, the 800 companies here. I think it was 400 last year. You know, we now have 500 bankers coming. The innovation economy globally around the world, including we've added like 50 alone here. So, you know, look, I'm a long-term optimist. I do think asset prices are high, credit spreads are low, and you know, you should take that in consideration how you think about the future.
When we talk about credit and you talk about debt, I'm thinking of some data, in fact, that JP Morgan put out on auto loans. Biggest losses in the most recent month, I think since 2020, March of 2020. Is that idiosyncratic to auto loans in the US, or are you seeing other weak links being stressed?
I think, you know, there were one or two frauds, which I won't go through, but in general, consumer credit was so good, it's basically, most of that's just normalizing for both credit card, but subprime auto is a little bit worse than normalizing. It doesn't look like it's getting worse from here, but it might. But a lot of that, if you look at the history of credit for consumers, it's employment. It's when employment or home prices go way down, which, you know, we don't maybe not expect, that drives, you know, credit.
The administration is talking about possibly changing the requirement around quarterly earnings. And you've talked about this, you've written about this with Warren Buffett around the guidance part of earnings and quarterly guidance. Would you welcome a change like that? And would it mean a change at JP Morgan in terms of how often you
I would welcome it. We still probably update investors quarterly with much less stuff, and we just very, very transparent. I think the bigger problem wasn't just reporting quarterly. It was forecasting where, you know, CEOs get their back up against the wall. They have to meet these things, earnings, and they start doing dumb stuff to meet earnings and that kind of public pressure. I think it's a smaller part of a much bigger problem. We've gone from 8,000 public companies in 1996 to like 4,000 today. And, you know, that I'm not sure that's good. We drive companies out of it. We have cookie cutter governance. They meet these things, earnings, and they start doing dumb stuff to meet earnings and that kind of public pressure. I think it's a smaller part of a much bigger problem. We've gone from 8,000 public companies in 1996 to like 4,000 today. And, you know, that I'm not sure that's good. We drive companies out of it. We have cookie cutter governance. Some activists are good, but they're activists. There's litigation. There's cookie cutter compensation. There's very expensive listing. There's, you know, disclosure rules, which you've heard about them here. I mean, endless rules. And then it makes it hard for a small company to go public. So I think, and they're trying to do that here, have an active small company going public. That's what we all need. And they create an equity culture, which Rachel Reeves was trying to do here. And I think they're doing a good job reducing regulations, you know, trying to make it easier to do business and, you know, reducing regulations in banks, but also in business in general. you want an active market. And we've kind of crushed it. And because the research laws and MiFID and disclosure requirements. So if I was a regulator, I would take a step back and look at the whole system and say, how can we improve it and make it safer? And look at it holistically as opposed to, just everything's like a one-off conversation.
I need to talk to you about some other changes that the Trump administration has taken. You are a champion of capitalism and free market capitalism.
Yeah.
So when you see stakes taken by the administration, or the US government, let's put it that way, in terms of Intel, golden share for US Steel, investments in a lithium mine producer, how does that sit with you?
Yeah. So the first thing is there are legitimate complaints around trade. So just take that first. Some are around just unfair trade. It's unfair to use, it's not just tariffs, it's surpluses, it's capital, it's quotas, it's just, it's the non-tariff barriers. And then there's national security related. So I think in national security, you have to take some special thing. I call it industrial policy, but it's got to be done right. It's got to come with permitting, no virtual signaling. And so like the deal that was done for MP, I thought they did a very smart thing. They're giving MP, which we were part of banking, does rare earth magnets, because they're going to have a long-term contract with the government, it gives them a chance to survive, to get through it. They call it the valley of death. And they bought a piece they're going to do that. So I thought that was really well done. I'm not going to comment all of them. I think you have to be very careful when you get involved in that kind of stuff. Why are you doing it? What's the long-term benefit? And then of course, if Democrats get in power, they're going to do even more of it. So I would be very cautious about how you go about that. I do think they need to do more. You cannot do certain things in the United States. You think a company's going to do it, they'll be bankrupt in 7 months. They either need free land, cheaper financing, and maybe the most important thing is long-term purchase agreements with defense or companies or something that gives them a real chance to build a business.
You touched on the fact, look, we're here in the UK. The Chancellor was here. She addressed the summit. She addressed the conference. She's making those changes. Is the UK doing enough? There are going to be potentially some changes when it comes to listings. They may be announced in the budget in November. Is enough being done to make the UK, to make London an attractive listing destination again?
Well, first of all, someone here, it's a wonderful city. It's a melting pot. The brain power is extraordinary. And I'm talking about not just financial, but lawyers and technology, media. It's unbelievable. It's a huge benefit to UK, though I'm not sure the rest of UK appreciates that much. And they're saying the right things. They're deregulating. It's not just banks, but business in general, reducing red tape. I call it blue tape now. They're reducing red tape, blue tape. They're trying to consolidate the pension and savings schemes, which I think is very smart. Have a little more of an equity risk culture. Not to lose money, but to take a little more risk. Or maybe some of these tech companies here. Yeah, I applaud everything they're doing. I know the public here doesn't applaud as much as I do, but if they have to keep going.
H-1B visas in the US, talking about attracting talent. $100,000. Is that a barrier to the US tech sector? Are you concerned about that?
No, I'm not. Again, I could harp around it. It's 600,000 employees. That's it. We have 160 million people working. And I do think, these things happen. I didn't like it when I first started. I still don't particularly like it, but you know what? It was being abused. We did the analysis and the work. It was not supposed to be to bring cheaper workers here to make more money for your company. It was meant to bring very talented people in that you don't necessarily have for your company. And we may have made some mistakes, but let's just fix the system. I was with the president once and he said more merit-based. In fact, I heard him say we should stamp a green card in every person in this country who went to university or advanced degrees and have them stay here and build their career here. That would be my belief. I want them to go back to that. Yeah. Not make it harder to be or make it easier for real merit-based.
You speak to the president every week?
No.
Okay.
I've spoken to him a couple of times.
Jamie Dimon, Chairman, CEO, JP Morgan. Thank you very much indeed. Really appreciate it.
To go back to that.
In this interview, JP Morgan Chase CEO Jamie Dimon discusses the intersection of technology, the economy, and government policy. Below are the key ideas from the conversation: artificial intelligence and jobs. Deep integration. JP Morgan has been using AI since 2012, spending roughly $2 billion annually. Diamond views current generative AI as just the tip of the iceberg, impacting everything from fraud detection to idea generation. Efficiency gains. The bank sees about $2 billion in actual benefits from AI, including reduced headcounts in specific areas and faster report summarization. Employment outlook. Diamond warns against putting your head in the sand regarding jobs. While AI will eliminate certain functions, he believes companies that retrain and redeploy staff effectively may actually see overall job growth. Economy and market outlook. Bull market and inflation. While currently in a bull market with high asset prices, Diamond is more nervous about inflation than the general market consensus. He suggests government spending and geopolitical factors could keep inflation higher than expected. Recession risk. He believes a recession is possible in 2026 but emphasizes that the bank is prepared to navigate through it. Government shutdowns. He dismisses shutdowns as a bad way to run a railroad, noting they rarely have a lasting, critical impact on the actual economy. The financial system and regulation. Public markets. Diamond is concerned that the number of public companies in the U.S. has halved since 1996. He blames cookie-cutter governance, expensive listing rules, and excessive litigation for driving companies toward private markets. Private credit. He remains agnostic about the rise of private credit, viewing it as a competitor that J.P. Morgan is happy to compete with or partner with depending on the client's needs. Industrial policy. He supports smart government intervention in areas of national security, like rare earth magnets or chips, through long-term purchase agreements rather than just subsidies. Global talent and immigration.
Agnostic.
H-1B visas. While acknowledging past abuses where the system was used to bring in cheaper labor, he advocates for a merit-based system. He supports the idea of stamping a green card on the diplomas of advanced degree graduates to keep talent in the US. The UK's role. He praises London's extraordinary brain power and supports the current UK government's efforts to deregulate and consolidate pension schemes to create a more active equity culture. Video link. Link to YouTube.
Agnostic.
In general, agnostic means claiming that something is unknown or unknowable. In business or tech, it means independent or flexible. If a person is platform agnostic, they don't care if they use Mac or PC. They just want the tool that works. They are not loyal to one specific system. Next step. Would you like to see how being industry agnostic can be a competitive advantage for an investment firm?
Tell me how committed you are to Tesla. Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all.
Well, no, I might die.
Okay, short of that.
I can't be CEO if I'm dead. So there's a slight amount of time.
Just tell me how committed you are to Tesla. Do you
How likely are we winning right now? Is America winning right now? And how likely is America to win the race for AI vis-a-vis China or anyone else?
For the next few years, I think America is likely to win. Then it will be function of who controls the AI chip fabrication. The factories that make the AI chips, who controls them? If more of them are controlled by China, then China will win. Almost all the advanced AI chip factories, they call them fabs, are in Taiwan.
If China invades Taiwan, what happens to the world?
Well, if they were to invade in the near term, the world would be cut off from advanced AI chips. Currently, 100% of advanced AI chips are made in Taiwan.
How like
Teacher Clint's business English lesson. Disaggregate. Finance definition. To break a total number into smaller, separate parts. Examples. The company disaggregated revenue by region. Costs are disaggregated into fixed and variable expenses. The report disaggregates data to show more detail. Teacher Clint's business English lesson. Disaggregate. Finance
Note 5. Fair value measurements. Assets and liabilities recorded at fair value are measured using the fair value hierarchy, which prioritizes the inputs used in measuring fair value. The levels of the fair value hierarchy are: Level 1, observable inputs such as quoted prices in active markets. Level 2, inputs other than quoted prices in active markets that are either directly or indirectly observable. And Level 3, unobservable inputs for which little or no market data exists, therefore requiring the company to develop its own assumptions. The company measures the fair value of certain equity investments, including certain immaterial equity method investments where the company has elected the fair value option, on a recurring basis, primarily within other long-term assets in the accompanying condensed consolidated balance sheets. The amounts of gains and losses included in earnings from fair value changes for these investments are recognized within other gains and losses in the condensed consolidated statements of income. The fair value of these investments is as follows. The fair value of these investments increased $2.1 billion and $3.7 billion for the 3 and 9 months ended October 31, 2025, respectively, primarily due to gains and losses resulting from net changes in the underlying stock prices of the investments and certain other immaterial investment activity. The fair value of these investments decreased $3.7 billion and $4.3 billion for the 3 and 9 months ended October 31, 2024, respectively, primarily due to the sale of certain strategic investments, as well as gains and losses resulting from net changes in the underlying stock prices of the remaining investments and certain other immaterial investment activity. Equity investments without readily determinable fair values are carried at cost and adjusted for any observable price changes or impairments within other gains and losses in the condensed consolidated statements of income.
This section of a financial report explains how a company calculates the current value of its investments. Since market prices change daily, the company must show how much their assets are worth right now, not just what they paid for them. To do this, they use a trust scale called the fair value hierarchy. The 3 levels of trust. The hierarchy tells you how reliable the price tag is. Level 1, highest trust. The price is taken directly from a public stock exchange, like the NYSE. If you can look up the price on your phone in 2 seconds, it's level 1. Level 2, medium trust. The asset isn't traded on a public exchange, but its value is based on similar things that are traded. It's an educated estimate based on real market data. Level 3, lowest trust, the black box. There is no market data at all. The company uses its own internal math and best guesses to decide the value. Breaking down the numbers. The table shows where the company's money is parked as of October 2025. Category. Value, October 2025. What it means. Level 1, $1.55 billion. Easily sellable stocks with clear prices. Level 2, $5.15 billion. Private or complex investments valued via math models. Total $6.71 billion. The total value of these specific investments. The big change, their portfolio grew significantly, from $3.04 billion in January to $6.71 billion in October. This happened because the stocks they own went up in value, and they likely bought more or shifted investments around. The bottom line, in plain English. Gains and losses. When these investments go up or down, the company reports that profit or loss on their main income statement, even if they haven't sold the stocks yet. Recent history. Last year, 2024, the value dropped because they sold off some big investments. This year, 2025, the value jumped because the stock prices of their holdings performed very well. The invisible assets. If an investment doesn't have a clear price, like a tiny startup, they just keep it on the books at the original cost until something major happens, like someone else buys in at a higher price or the company fails. Would you like me to explain why a company might prefer to have more level 1 assets than level 3 assets on its balance sheet?